Hi there, welcome back. This is Mitch Argon with Calneva Realty. I'm going to take you through the December 2025 market update for Reno Tahoe in just a moment. Okay, let's jump right in. We'll start with median price like we do in prior months. Keep things consistent for you to follow along. As you can see, most of these markets are in the low to zero single digits. We do have the Carson Valley at 20%. This is not a market that's rising at 20% per year. We just have 1 month that we happen to have a low a year ago and probably a high now on a relative basis that gives that number. But most of these markets are stable. You can see here stabilizing out into the low single digits. And we probably expect that we'll see that through 2026 as well. Not a lot of price appreciation in the forecast. If you take a look at this visually, you can see the last 2 years going back. And this chart really should be going back to about the middle of 2022, which would be about 3.5 years, because that's when most of these prices kind of reached their peak market. That was before interest rates started to rise. And if you look at these numbers carefully, you can pause the video and look at these numbers down here. You'll see a lot of consistency in these numbers. For example, I'll just pick one out. Here's Dayton at 402 2 years ago, but you can see it was more like in the 450 range at that time. This 402 was probably just a low month. And if you come forward here to 1 year ago in November, 451. Last month, November, 450. Very stable on the pricing. And that's pretty much true for all of these markets in through here. If you just go back and take a look, highs were met, or close to highs were met middle to late 2022, and that's about where we are now. Homes sold, coming over here to the center column here, you can see it's consistently down with the exception of Carson Valley. This 74% increase is, again, probably a strong month here in November, coming off of a low month 1 year ago. But generally speaking, we are seeing the market slowing, and we are seeing pretty good activity on pendings, but there's this phenomenon nationally where there's a lot of homes that are canceling and falling out of escrows, which we see as markets kind of go through a transition from a seller to a buyer market and vice versa. So you can see here the sales are off, and that does translate into more days on the market. Generally speaking, we've seen that go up from probably 25 days a year ago to probably 40, 45 days, maybe somewhere in that range now. So the markets have slowed a bit, and you can see that here. Month supply of inventory, which takes into consideration the inventory and the sales combined, you can see is down and up. It's a little bit of a mixed bag, but for the most part stable. You can see here that Dayton is up quite a bit. It was low a year ago. They've had more inventory come on here in Dayton, so it's 2.7. All of these markets that we're looking at, with the exception of Tahoe, which really doesn't typically apply. It's a very different market, being a second home market primarily. But these markets up here, the primary markets, are all below 4, which technically means we're still seller market territory, stingy inventory. And although the markets have slowed, giving the buyers a little more opportunity, a little more power in negotiations in spot cases. Inventory, you can see down again as well, with the exception again of Carson slightly up, and Dayton. This is one of the reasons Dayton month supply of inventory is higher, is because there's a 46% higher in inventory this year than there was a year ago. We are seeing inventory holding low. If you look at a visual on that, you can see here, I'm using this red line here just to highlight the Reno market because that's the easiest one to see in the chart, but they all will follow a similar trend. You can see we're sitting here in December at 632. A year ago, December, we were at 644. So we actually have less inventory today than we had a year ago in December. If you go back 2 years, you can see we're at 469 back over in here. That was chronically low. It was still coming up from where we were during the pandemic, but it was chronically low. So it's coming up, but you can see from year to year here, it's pretty stable as you look at each of these markets. And so we do have sluggish inventory. And that's all a direct effect of the higher interest rates relative to where they were during the pandemic, and kind of a lock-in effect that we call. Month supply of inventory. This is for people. We often get calls from people that they think the market's going to crater. This is your best indicator as to whether the market is really a good time to be aggressively buying, like really driving a good deal or if it's going to be competitive. And you can see we're below neutral territory, which is neutral pricing. We're still in seller market territory, and we have been for a long time. These numbers changed very slowly. When they changed in a significant market change, they changed dramatically. This scale goes to 10. Back in 2009, 2010, this scale would have been up to probably between 15 and 20. And all these numbers would have been up there in that 17, 18 month supply of inventory range. At that point, there was a tremendous downward pressure on pricing, and the prices were falling. And so this number, while it doesn't look like it moves very much, is really a great indicator for whether the markets are, if pricing is going to be going down or going up. In this case, we're holding neutral. You'd expect to be probably more in this range in here, but that low inventory is what's keeping these numbers down. So we've talked in prior months about inventory levels relative to pre-pandemic, which is 2019. And so this is a chart that we're keeping an eye on. I'm just sharing it with you. Here you have 2019 with this kind of burnt orange color or this lighter burnt orange color, and that runs right through here. And you can see compared to 2025, which is this darker burnt orange color, almost brown, we have remained fairly consistently, if you look at this gap, fairly consistently below the 2019 levels. We're getting a little bit closer here in December. You can see from 1342 in 2019 to 1276 today. These lines have not crossed. We'll track this into next year. If they do cross and this dark line becomes substantially higher than the orange line for 2019, that's going to start to put some pressure on prices. But until we see that, we're probably not going to see that phenomenon that we've seen in other parts of the country like Florida, Texas, and so forth. So I thought I'd do a quick summary and a peek into 2026. We'll talk more about 2026 next month. But this is kind of just a summary of 2025. It's been really a lot more of the same. Home prices remain stubbornly high. That's affecting affordability in a big way. Interest rates have come down slowly. We're down to about 6.3% for a conventional loan, but we're down from around 7%, but we're still well above where we were pre-pandemic, or I'm sorry, during the pandemic, where a lot of the rates were probably more like 3%. Days on market has edged higher, as I mentioned earlier. It's probably running now in the 40-ish days versus the mid 20 days. This low interest rate lock-in effect that we talk about a lot, have talked about a lot, continues to suppress inventory. As you've seen, inventory levels remain low, and that combined with this challenge in affordability is what's keeping these prices, pretty much flat. Sales volume, which is the byproduct of this, remains sluggish. The volume of sales in the market is actually, on a national basis, it's about where it was 30 years ago, like in the mid 1990s. So a lot less people at that time, a lot less homes. So sales in the real estate market, residential market, are tamped down quite a bit because of these factors that we're talking about: affordability competing with a lock-in effect. Quick look into 2026. I certainly don't have a crystal ball. I don't really know anybody who does. I don't proclaim to, but so I've got a question here, and one thing I'll close with, but the term affordability is going to become a big buzzword into 2026. It's already started, and we have midterm elections next year, next fall. And so it's going to be labeled on just about everything we're hearing in the media, and housing will be part of that. We'll cover a lot of other things as well: fuel, food, and other, insurance, etc. But for housing, my forecast is that the word affordability will compete to become perhaps the most overused word in 2026 with the elections coming up. So that I feel pretty confident in. What's going to happen in the marketplace? Well, will any of the interest rates reductions that we get in 2026, that we're thinking the rates are going to come down, improve affordability in a meaningful way, and or loosen up the lock-in effect, again, in a meaningful way? And we'll find out. This is a question we'll be asking and looking at as we go through 2026. But we'll have to have a substantial change in the interest rates to really move these markets away from this dynamic or this lock-in that we have right now that we talked about. Okay, with that, I'd like to wish all of you out there a Merry Christmas or Happy Holidays, whatever you celebrate this time of year. A very Happy New Year. We'll be back online in January with this report, to give you a recap of 2025 with the actual numbers for the full year. Hope you enjoy your holidays with family and friends. Have a nice, relaxing time. And again, as always, the full report for the numbers I'm pulling out is down below this on YouTube. There's a link that will take you back to our website. And if you want to drill down on any of these numbers in more detail, you can access that report. It's like 40 pages long, and look through whatever you like. Appreciate your watching. Thank you for your support. Have a very Merry Christmas, Happy Holidays, and we'll see you in 2026. Thank you.